You've probably heard China's official debt number before, but what if I told you the real figure could be double that? Officially, China reports debt levels that seem manageable, but when you add in provincial governments, state-owned enterprises, and hidden obligations, it balloons to nearly 300% of GDP. That's not a small difference. That's a system that looks transparent on the surface, but hides a deep complexity underneath. Why would such a powerful economy keep its true liabilities off the books? And what does that mean for stability worldwide? The official numbers versus the reality. What if the number everyone sees isn't the one that matters most? On paper, China's debts seem large but still under control. The official ratio looks closer to what other major economies carry. But independent studies suggest something very different. Borrowing could be nearly double what the government data says. That gap is huge. It raises the question, is the real burden hiding out of sight? Or is the way the numbers are arranged creating a false sense of safety? The difference comes down to what gets counted. When Beijing announces figures, those tallies mostly reflect money the central authorities themselves borrowed. It's tidy and looks stable compared to national output, yet when private analysts calculate, they don't stop at the capital. They add debts taken on by local governments, public projects, and layers of state-backed agencies. Stack those together, and the headline nearly explodes. Suddenly, the same economy shows two very different faces. One calm, one stretched thin. It's like checking a family's bank account and thinking everything looks normal while ignoring the pile of credit cards in the drawer. The official balance makes sense, but it misses the picture of how much is owed across the whole household. In China's case, each province or municipal body can take loans to finance projects, often through corporate-style structures known as financing vehicles. On paper, these bodies aren't the state, but everyone knows they answer to the state, and their debts mount rapidly. This split makes the puzzle even harder to read. Official statements frame the obligation as light because they only include part of the house, while outside observers argue the rest cannot be safely ignored. For example, when a provincial authority invests in highways or housing complexes, that liability is labelled as local, not national. Yet, for investors or rival economies, it makes no difference where the loan is assigned if the entire system is expected to stand behind it. Comparisons to GDP also play a role. If the central state accounts for only a portion of borrowing, it looks modest when measured against the vast economy. But switch to the broader estimate, and suddenly debt exceeds 2 or 3 full years of output. The numbers not only change, they tell opposite stories about the health of the system. One makes China appear safer than many of its peers. The other shows pressure building behind the curtain. So we face the paradox. Why present a sleek version when private calculations hint at far greater weight? One explanation is incentives. A government has every reason to show manageable levels. It signals control, it keeps investor mood steady, and it avoids sparking panic at home. Meanwhile, independent monitors try to capture the liabilities where they really sit, with local administrations, agencies, and enterprises that act with the government's blessing, but not its direct oversight. Both tally sheets could be technically true, but only one shows the full scope. This divide leaves open another question. If so much debt is parked outside the main books, what else might never surface in official figures? Debt may be the most visible example, but it hints at a wider challenge in understanding where risk hides in China's economy. What rests on the page can look sturdy. What sits below the page might be fragile. The key takeaway here is simple. The official line isn't fake, but it's incomplete. It tells us how much one layer of the system owes, not the entire edifice. If you rely only on that, you're seeing half the movie. The fuller story only comes into focus when those provincial, municipal, and corporate-backed debts are added in. And that's where the scale jumps to levels that alarm so many analysts. Now, the real question becomes, where exactly does all this hidden borrowing live, and who holds the responsibility when bills come due? The local governments and SOEs behind the curtain. What happens when the money isn't borrowed in Beijing, but scattered across hundreds of provinces and state-controlled companies? This is where the real weight of China's debt sits. The economy we often think of as centrally planned is actually built on thousands of decisions made by local bodies trying to deliver growth. Roads, railways, office complexes, entire suburbs. They don't appear out of thin air. They're financed, and a lot of that financing takes place far from the capital. For decades, China has leaned on its local governments to be engines of expansion. When growth targets were set, it was the provinces that carried the burden of making them real. A new industrial park or bridge might boost numbers quickly, but the cost piled up on local ledgers. Instead of borrowing directly through the central treasury, many of these administrations created financing vehicles, quasi-corporations designed to raise money for public projects. The label makes the borrowing look commercial, not official, but the distinction is largely cosmetic. The debt is still there. Now, picture what that means in practice. A city administration might decide to build a subway line, a sports stadium, or a network of new highways. All of it can be charged to these vehicles. On the surface, it looks like business investment. The central books never show it, so Beijing's official figures stay relatively neat. But underneath, billions in obligations are stacking up, tied to projects that may or may not pay for themselves in the long run. It's like furnishing your home with a credit card while telling your family budget you only spent what came out of the checking account. The role of state-owned enterprises only makes this more complicated. These firms are often massive, covering sectors from transport to construction. They obtain loans under the assumption that they're too important to fail, then pour the money into infrastructure, energy projects, and even speculative investments. Because they stand one step removed from government accounts, their liabilities don't show up in national debt statistics. Yet, when they hit trouble, the expectation is clear. The state will be the ultimate backstop. This structure works neatly for official reporting. The government can claim a relatively low debt figure at the top, while the actual financing burden is distributed across countless smaller units. But spreading it out doesn't make the risk vanish. It simply shifts it into places where global investors aren't trained to look. You can imagine it like water seeping through cracks. The central dam looks sturdy, but the pressure is building across a wide and hidden network of channels. That pressure is exactly what analysts worry about. Because these entities are linked to the state, their borrowing carries an assumption of safety. Creditors and banks operate on the idea that, if push comes to shove, Beijing won't allow them to default. In one sense, that keeps money flowing, lenders feel reassured, but in another sense, it creates what economists call moral hazard. Risks are underpriced, and projects keep multiplying even when they have little chance of generating real returns. The bill grows larger while accountability becomes more diluted. Think about the incentives. A local mayor may want to show strong growth numbers quickly, so funding a flashy project through a financing vehicle delivers the result. At the national level, leaders can point to rising GDP without admitting to equivalent rises in debt. Everyone looks successful in the short term. Over time, though, the stack of obligations grows too big to ignore, and the supposed separation between local and central finances starts to blur. The cycle becomes self-reinforcing. It's not just about the size of the debt, but also about how opaque it is. With loans spread among thousands of local units and enterprises, it becomes harder to track who owes what, which projects are solvent, and where systemic risks may be hiding. That lack of transparency magnifies uncertainty for anyone trying to assess the long-term stability of the Chinese economy. If a problem arises in one province or one giant state firm, investors quickly assume it could spread further than reported. So the debts exist throughout the system, embedded in layers of entities that look separate but remain connected at the core. They aren't counted as central obligations, yet every observer knows they're tethered to the state's credibility. That's why the gap between the official numbers and the private estimates is so wide. The responsibility isn't where it seems, and the risks are hiding in plain sight. But if the liabilities are spread this far, the next big question is whether assets on the other side of the ledger can balance everything out. The other side of the ledger. Is China truly drowning in debt, or does it actually have enough assets in reserve to offset most of what it owes? That's the real debate. Unlike many other countries, China's government doesn't just collect taxes and run budgets. It owns enormous chunks of the economy outright. Land, power utilities, shipping ports, oil companies, telecom providers, the list goes on. These aren't just scattered holdings. They're vast enterprises that in theory could be used to balance debt. On paper, that looks like a significant safety net. Now, the question is whether those assets make China safer than what the raw debt numbers suggest. On one level, the argument is simple. Because the state holds ownership over so much, it can tap into those resources if pressures build. Many governments don't enjoy this reach. For example, when you consider that every parcel of land in the country is technically owned by the state, it gives authorities an extra source of leverage. Through a distinct land lease system, local authorities can sell usage rights for decades at a time, effectively turning property into a revenue stream. In the past, those sales have been a major source of cash for local governments, helping them service loans and continue building. The scale of assets also appears staggering in estimates. Some calculations suggest the Chinese state holds wealth that could be worth over 20 trillion, and some argue double that number. A spread between 20 and 40 trillion in value is enormous. When you put that against a debt figure of 3 times GDP, it seems like China might own more than enough to backstop its liabilities. To many, that looks reassuring and confirms the idea that the debt problem is overstated. After all, if you're richer than what you owe, why worry? But here's where the promise collides with reality. Those assets are not always ready cash. They come with strings, and they live inside an economy designed for stability, not liquidation. Selling huge pieces of land or breaking up major state companies to raise money would shake the system. It might create winners and losers in ways that the party leadership isn't willing to risk. In other words, the balance sheet looks heavy with value, but converting it into something that can actually repay debts is far from simple. You can think of it like owning priceless artwork. It might look amazing framed on your wall, add prestige, and boost your estimated net worth. But if bills pile up and you suddenly need money, selling that art at full appraised value is nearly impossible. Markets won't absorb it quickly. You'll take losses. And letting go of it might also change your identity or reputation. China's situation is similar. The government holds prized assets that anchor its control over the economy, but liquidating them under pressure could undermine the very stability they were meant to guarantee. Land rights in particular expose these limits. The lease system has been reliable for decades, but in recent years, the real estate market has cooled down. That means selling more land use rights isn't the easy fix it once was. Revenues from those leases have dropped, leaving local governments who relied on that channel struggling to fill holes. Assets can't always perform on schedule, especially if the broader market is slowing. What looked like guaranteed wealth becomes tied up in cycles outside the state's total control. So yes, the state has deep stores of wealth. Compared to other countries, it may have more levers to pull. But the difference between asset value on paper and money that can pay creditors is not minor. It's the dividing line between calm and crisis. China's position might be strong in theory, yet fragile in practice, because mobilizing those holdings without harming growth and trust is extremely challenging. The assets exist, they're real, but they can't be easily transformed into ready cash for debt service. This is why the comfort of knowing the state owns enough often fades when practical questions arise. It's not just a math problem, it's a political and economic choice. Beyond the numbers on the balance sheet lies something bigger: the way China organizes its political economy, the rules of reporting, and the motivations for why so much borrowing remains hidden in the first place. Why the numbers stay hidden? Why would any government choose to blur its own debt picture? In China, the answer lies as much in politics as in economics. Official data is not just a record of financial health, it functions as a message to the public and a signal to the world. Reports about borrowing levels and growth figures are shaped to show stability, because behind those numbers sit political promises. When a target is announced, meeting it becomes an expectation, and leaders at every level know they will be judged by whether they deliver. In that kind of system, smoothing the numbers can feel less like deception and more like survival. Now, consider growth targets. They don't just describe the economy, they operate as commitments, almost guarantees. Hitting them reinforces the idea that the government is firmly in control. Missing them raises doubt, which is politically sensitive. That's why debt data often tells only half the story. If rising liabilities are shifted into categories that don't officially count, headline debt remains manageable, while growth still appears strong. It's easier to claim success if the risks are not sitting in full view. For outside observers, this creates a puzzle. Analysts have long pointed out flaws in reported macro numbers, such as GDP tallies, that don't add up cleanly or omit significant factors. Irregularities in those areas highlight how the problem isn't limited to debt alone. The logic is the same. When stability depends on hitting specific growth marks, local officials find ways to pad results. They use new projects, shift borrowing into discrete channels, and keep liabilities away from the central books. Those tactics allow them to show they have delivered without raising alarms about dangerous debt levels. Think about how this works at the local level. Suppose a provincial leader wants to hit a growth target. Instead of cutting spending or presenting lower numbers, they can direct a financing vehicle to borrow and fund construction. The result adds jobs, boosts activity, and looks positive on paper. The loans, however, may never be fully repaid. They sit uncounted, while the result is reported as central success. In this sense, off-book debt acts like a hidden reserve of political capital. It's a tool for presenting progress. But here's where the danger builds. The same strategies that add flexibility today can create blind spots tomorrow. If a slowdown exposes cities and firms that borrowed far more than expected, nobody has a clear map of where the risks are buried. The illusion of stability then works against the system, because even policymakers are left with incomplete information. A hidden shock is always harder to manage than one measured in advance. What looks less threatening in the short term may prove more disruptive in the long run. For global investors, that opacity is a problem on its own. Financial markets rely heavily on official reports to gauge the strength of the world's second-largest economy. If those reports present a carefully staged version, every calculation downstream becomes more uncertain. Lenders, partners, and trading partners are left second-guessing. The issue isn't just about China's internal stability, it shapes how confident the rest of the world feels in dealing with Chinese banks, firms, and markets. Trust in data isn't abstract, it influences capital flows and international relations. So the hidden debt sits at the center of something larger. it is not just an accounting detail lost in spreadsheets. It is part of a deliberate structure tied to how political legitimacy is maintained. By presenting manageable numbers, leaders reinforce the narrative of control, while risks are shifted to spaces that avoid headlines. The costs don't vanish. They circulate through the economy in ways hard to see. What looks like prudence is in fact a trade-off between political certainty and economic transparency. This distinction matters because the choice to obscure is systemic, not accidental. It reflects priorities. A visible debt problem threatens confidence at home and abroad. A hidden one buys time, but at the expense of clarity. And that leaves us with a bigger question. If the hidden debt is this significant, what impact could it carry beyond China's own economy? Conclusion: the debt figure near 300% of GDP is more than a statistic. It highlights how much trust and transparency shape global stability. Numbers alone don't capture the risk. What matters is whether investors, governments, and citizens believe those numbers reflect reality. Hidden liabilities challenge that trust, and when the world's second-largest economy carries this weight, uncertainty spreads across trade, finance, and growth. We all share the consequences of how China manages it. So let us know what you think in the comments, and don't forget to subscribe for more breakdowns on the forces shaping the global economy.